Hello traders, welcome to FreeFX. I haven't done a video in a few days. It's been longer than a week. I've got quite a few things to tell you about today. Really, I wanted to talk about where we are in terms of the euro, and also talk about risk trends, because that's really what's affecting the current price store. So let's start with this kind of quite complex chart. What we've got going on here is the Euro USD. That's the blue line. It's a close price, and really the line kind of makes it a bit less cluttered, and we can see that the line in blue is really trapped in this long-term range, this downward channel, which I created some time back. And I've sort of gone back to it because for a while I wasn't really looking at Euro USD, so I've had to kind of draw it again. But really, it kind of joins all the dots nicely together, and you can see that essentially we are in this range, have been for some time now. The latest developments here, we seem to have that's the kind of middle line, or the sort of regression line, if you want to call it that. And we kind of come close to it and then away. When I say close, not really, but anyway, sort of in the region of. And as you can see, that sort of provided support before. And we've gone past it and then all the way up to the top end of the channel. So now we kind of curled up just beyond that, and it's the first time that, as you can see, the line is kind of gone beyond. Of course, you could say, well, it depends how you draw the line. So just to be absolutely sure, I'm going to really look at what matters. This is the monthly chart of the Euro USD. I'm going to use candles. Now, on the candle side, you can see, for example, that on previous occasions, we had in the past a candle that went all the way to the line, and then there was a wick above it. That wasn't really the start of a trend, because that's just where we draw it from, but it wasn't really the start. So it confirms around here. And now, obviously, if you draw it to here, you could say that we have a lower kind of top area that intersects this, and so we definitely have broken that. But even the top one, in the last month, so in August, we have gone above it, just not by much, kind of nudged above it. We now have in this month, current September, we have this measly candle. If you don't know the term of measly, I mean, it's pretty unimpressive. We've got this tiny little candle, and it's pretty much a doji. I mean, if you looked at the weekly candle for last week for Euro USD, you'd see what I mean. It's really just a doji. I mean, there's no doubt about it. That is a doji, right? So that hasn't helped things. This week we've got the FOMC rate decision coming tomorrow and the press conference in the evening, but for the Fed. But I really don't think we know what's going to happen, how the market is going to interpret that, etc., etc. So based on that, then we can say, well, okay, so what do we have to compare this with? Let's talk about risk trends then, because as I said, this price here, sort of 119, it's not really actually going to tell us much in terms of anything, because we have essentially retrieved the information that we have from past price, which is that 119, kind of where we're at now, is not particularly a strong price in any shape or form. Yes, it was sort of touched on here in 17, so 3 years ago, which is kind of recent enough, and it still has relevance, but it's not really like a price we keep going back to. Like, for example, the bottom of this range, around 106. Now that is, you can see it's from March 2015 all the way to March 2017. So that's 2 years, and we've gone on it 3 or 4 times even. And that's a very strong kind of price. 119 is hard to break. So in other words, historically it may not be a strong price, but currently it is. It's a price that's hard to break. We've gone above it to 120 before, as you can see up here, in the kind of February-March period, and then come back below it. One thing that I would say is that if you look at the daily chart, just to give you a slightly more in-depth view of that, we could say, it's not really to say it's absolutely the truth, that this is actually a triple top. And why do I say that? Because if I make this a little bit more obvious, you can see exactly what's going on here. We have 3 little humps there, okay, And so if I hide gold and come back to it in a second, you can see 1, 2, and 3. Now it's slightly slanted, so it's not a true triple top where, say, the left and the right humps, like in Head and Shoulders, are at different heights. But in a triple top, they should all be about the same. They're not. It's more like a little channel going up, and it's broken, and we've gone back to. So imagine this is a little channel. Essentially, you would have something resembling this. You'd have a channel with this, and maybe just kind of draw it a little bit more slanted to this kind of angle, and then do another channel where it's the, so even without doing a channel, just do like a little mini trend line, and we kind of broken below it, and then we're back to it. So two things can happen. One, that if technicals mean anything, and these kind of small technicals may not actually mean anything at all, although this is going back to July, so we have essentially 2 months worth of price action. So it's kind of going back enough, but it's a kind of mini triviality really in comparison in the context of what's happening. But we're going back to this, so they could either sort of function as resistance and take the price back down into this bigger 12-year channel, or it could continue higher, in which case we'd have to kind of rethink this trend line and make it slightly lower like this, or maybe slightly less angled, and make it this sort of slightly shallower angle, in which case this is a slight dip below and then it continues higher, and it's more like a channel that's rising. The other thing that can happen is that we have essentially a triple top, and we can draw it like this, where it's not entirely symmetrical, but if you take this sort of view, or even a double top, then you could say that this is essentially stalling, and the price for this would be about 119.30 or something like that anyway, or 119.50 if you like round numbers and halves. 119.50, yeah, so this would be a barrier to progression to 120. And that's basically where we're at. So we could say, well, we've had 1, 2, 3, 4, 5 straight days of rising euro, but when you look at something like, for example, if I put an indicator here that might be such as the average true range, let's say, and give it the usual kind of 14-day period. Now you can see that from March, where we had this sort of huge rush and subsequent months, we've actually had a sort of range between 79 and 98. So 79 and 100 basically pips per day as an average of the last 14 days for each measurement. So we're actually in the low of that range. We're about 78 again. And this undulation, it's even more extreme if you take the weekly chart, for example. You can see the drop from the March down to where we are now. Essentially, because of the ATR and the price diverging, you could say that, well, price was going up. The you can call it depth of market, and it's not a centralized market, the spot foreign exchange, but essentially whatever is going on with the euro, the base currency, it's actually, this is showing a decline. And because that's really showing a decline, we have true divergence over a number of weeks and months. So from March to September, we have a divergence. And this really has continued all the way through while price has been rising. That makes me think actually that this potentially does have some leg, and we can really do something with that. Indeed, I could probably haphazardly, I could probably say that we have the possibility of doing something with this. Let's take the Dixie, for example. That's the dollar index. I'm going to take that and do the full feature chart and really sort of take advantage of the charting from TradingView. Now, of course, it's the same chart that I was showing you a second ago, but this is actually the dollar. Now, you could say, well, the dollar is severely downtrending, so we don't really need to worry about, If you put indicators on that, we've got a simple moving average. We put a moving average with a change the settings of that, and we give it period of 200. We'll give that color a dark red. Okay, and then we've done that. That's a 200. We crossed the 200-day moving average back in May. So about 4 months ago now, and we've stayed below it all the way. And then we can say, well, even more than that, actually what we've got is another moving average, which is a typical moving average cross strategy. And we put that one in, and it will assign its own kind of value. I'm going to change that again, not 9, but give it a 100 and make that orange. The input will be 100 days. Because the chart is a daily chart, instead of just calling them periods, we call them actual days. So that's the average for the 100. So the 100 has crossed the 200 back here precisely on the 7th of August, so just about a month ago. And that means that essentially the cross of the 200 between price and the moving average was back in end of May. And at the beginning of August, the 100-day moving average crossed the 200, thus confirming. But by this point, we had quite a huge discount. Even the price had gone down quite considerably already. And obviously, at the moment, we're down in the sort of 92s. And there's a lot of support here, as you can see. And that means that essentially we have, I talked about triple top earlier with the euro, but if we invert it, because this is an inversion of EUR USD chart, and that really tells us that we have a triple bottom potentially, or a double bottom. And so the double bottom is around 92, about here. So if I put a little line there to remind us where the double bottom is, that really tells us that we're not really messing with this. It's staying put. It's not really going anywhere. That's a set to a 92 right there. Okay, so this also combined with another thing, which is an indicator. I'm going to put an RSI there because this gives us an idea of divergence again, based on this. We don't really have volume for this as such, and so we just have to go by. Now, I've set it to 70-30, but I can be a bit more extreme than that and do what I usually do to filter out some of the noise, is to set it at 80 and 20. And then that kind of gives us a little bit more, and the upper band I'll do slightly thicker line and make it quite dark, and the bottom line as well I'll make it quite dark so we can see clearly that we are in the middle of this. So essentially the divergence here is quite obvious to see what is going on. Let me just put a little divergence there. I'll do it at the bottom instead because the top is slightly asymmetrical. So there's my rising trend line on the RSI, and I'll just kind of tailor it a bit more to the bottoms there. And all the while, the dollar was actually, from the start of this divergence in July, it was actually coming down, and now we've broken through that. It's picked up, so now the RSI indicator and price from the 7th of September, so sorry, the 2nd, in the last kind of week, 2 weeks, almost, have harmonized. So price and RSI have harmonized. Now, this is no guarantee of anything, of course. We were severely oversold at 20, and this is a daily. So if I wanted to just squeeze a little bit more price action, I can do that quite easily and check where we've been oversold before. We were oversold during the March epidemic at the beginning of March, and then it sort of bounced back all the way to the sort of low hundreds. And the previous time before that, and there was no RSI divergence. I mean, the price came down the same as the RSI. The previous time that we were oversold wasn't for quite some time, by the looks of it, almost oversold here back in July 2017. And RSI started climbing and price was coming down. So there's a bit of divergence there, and then eventually price started coming up when it was oversold again here in January 2018. RSI went up and price after some consolidation started going up again. So the early signal here was about let's see, RSI going up there, going up again here. So from February, it took another March, April, a couple of months for price to really take the hint, if you want to kind of look at it that way. So it's not to say that this divergence that we're looking at now is going to play out in the immediate, but this divergence has been going on since end of July, beginning of August. So it's been at least a month and a half. So I think this is going to play out soon, based on the previous time when it was severely oversold and we had a pickup of any significance. So if we are looking for anything, I mean, that is a good hint as to what might happen. This time back in 2018, we were at 88, or actually sort of more like 89. So not too far away, and then it was basically an uptrend all the way to here, the sort of 100 mark. This price, what we're at now, the sort of 93, as you can see, this red line here has played out some kind of significant level before, back in 16. So there could be a historical reason why that price is significant. We can also apply cycle theory and look at cycles and see whether that's something that we can apply to the situation. But let's go back to our previous chart, which was this one. So risk trends at the moment are quite confusing, and that's what we need to talk about briefly. We've got this chart of the SPY, SPX, which is the S&P 500, and now you can see that we have this drop here from the March COVID situation and the pickup. It hasn't really progressed that much. I mean, that's the 33.79, whatever it was. We peaked at 35, and now we're down to basically where we were back at the top there before we had a correction. So the euro has kind of synchronized with the S&P 500 since. It's responded to the stall in the S&P in a similar fashion, and this really doesn't tell us much, because the S&P 500 options expected volatility over 30 days is essentially a measure of what the market, so to speak, thinks of the S&P's risk exposure in its current trend. So if we look at everything and we take the S&P 500 out and we look at the VIX, the volatility index, you can see that it's still elevated because the low here is 21 point something and the high is 30, and we're now at a 25 just about. So it's still elevated compared to what it was before the COVID crisis, when we were in the below 20 certainly, and even down here to 11 or less. And that means that there's still there was a little spike here, and there's still some kind of expectation of increased volatility, which usually translates into people buying more put options for the S&P 500. So that means that they expect a drop and they compensate as a hedge by buying short options or puts, and that is what the volatility usually indicates. And that's why usually it's a mirror version of the S&P. The VIX goes up, the S&P comes down. Now it's like a chicken and egg, really. So by looking at the VIX, you can't really predict necessarily what the S&P 500 is going to do. But the fact is that it's still elevated reflects some anxiety in the S&P 500 crowd, and anybody who sort of uses it as a kind of feel for the market and sort of decides that that is a situation that they want to have insurance against. So this kind of tells us as well the fact that the S&P is struggling, the VIX is elevated, that the euro isn't progressing, the the gold, let's take gold back up just to see where we're at with gold. The gold also has this stall. I'm going to put it back to the daily so you can see what I'm talking about. I'll just hide the other ones. I'll hide the VIX. See, the gold has kind of stalled just like the euro, but unlike the euro, actually, what you can see is that gold has basically, if I just turn that one like this, you can see that gold has sort of formed a wedge, and that wedge essentially is telling us that we are going to have a break. Now, what that break will look like, nobody really knows, but that essentially, you can see we are converging. So the bottom is rising and the tops are converging. Now, obviously, if you have it like this, also they are converging. And so this range is getting quite narrow. If you wanted to trade the break to the upside, you take the top and the bottom of that move, and essentially you'd add it to your entry point. So if your breakout was here, you'd add this distance up. So you aim for, in terms of gold, 120. Sorry, 2047. We're at 1968. So that's what you. So you basically you'd be aiming for these stops, or if you took that from here, but that's not quite correct. Let's have a look at the candle side of things. If I looked at this as candles, for example, we might give us a bit more detail. Okay, that's the wicks there. So we might say, okay, we'll take it from the top of this, which is a solid red candle, and then go down to here. That's the wick there. So we take the open as the bottom of that, and here. So that's more like it really. And in that case, this basically would be what you would project from your breakout entry upwards. So it's basically 1, 2, 3, 4 boxes. So 1, 2, 3, 4. You're aiming for something in the region of 2070. Now the breakout could be to the downside as well, in which case gold is well poised because it has risen quite significantly, and overall the trend is up historically for gold, as you can see. So it might be that the trend is overdone. We've not had something resembling this kind of triangular or flag or pennant or wedge, you can call it many things. We've not had a shape quite like this just looking at the chart for some time. So this is really quite significant. So what I'm talking about is a convergence of a lot of these strong kind of stalling situations around key levels that that these assets are fighting with, and because it's across asset classes, it's currencies, it's metals, it's indices or equities, it's really quite options. It's really quite important to realize that this is not just a coincidence. It's a convergence of different factors, and so we are actually really potentially looking at an explosive Wednesday with the FOMC rate decision, which may provide no upgrade to the information or forecasts or anything like that, but essentially could be a catalyst that the market is looking for just to find a way out of this stall. There may be other things, geopolitical developments, trade wars, US and China, Brexit. There may be a number of things, but essentially, I think tomorrow might be as good a day to expect some kind of resolution, or at least some kind of movement in the right direction. But this is going to take a lot of conviction to get past, so I'm not sure exactly what we're going to do next. Anyway, this is the end of my video, so thank you very much for watching, and leave a comment if you can. Thanks, bye.